Hi, it's Amar. And this week I got a lot of questions about how different accounts are being taxed. And I thought I'd go over three of the basic accounts that people can have and how they operate and how they differentiate between taxes. So the first account that you have is kind of after your paycheck, where does your money go? And that goes into a savings account. If you take some money from there and put it into an investment account, we call that a non-qualified account. So you can have an individual account, joint tenants with right to survivorship type of account. But we're going to look at how it's taxed. So obviously the money, since it's coming from your paycheck, is after taxes. First thing you should know here is this bucket, money's coming from your paycheck. It's after tax. We call this a non-qualified account. Every year you get a 1099 for the interest that you earn. It may not be a lot of interest in dividends, especially in this low interest rate environment, but you still get taxed on it. And when you sell a security, you have to pay capital gains tax. Capital gains tax is broken out in two parts. There's short-term and then there's long-term. Short-term is ordinary income rates, and long-term is capital gains rates. Long-term capital gains rates, which are currently, for most people, 15%. And can get as high as 23.8 when you add in the Social Security surcharge tax. All right, so then the next account we have is called a pre-tax account. Now, this has traditionally been a 401k, IRA, 403b, 457 plan. These accounts are all pre-tax. Now, I know in the last couple of years, there's also Roth 401ks and stuff like that, but we're just going to focus on the pre-tax. So let's dive into those now. All right, so these accounts, 401k, 457, 403b. Let's assume we're putting pre-tax money in, so it's before tax, right? So it comes before your paycheck, before your pay stubs. Here, you don't get a 1099 each year, so they grow tax deferred. And when you take money out, you have to pay 100% ordinary income tax. So you're paying ordinary income tax on the total amount that you withdraw from these funds. We're assuming that you're withdrawing these funds after 59 and a half to avoid any penalties or anything like that. So the next type of account that you have is, in the third bucket, is really the Roth IRA. And to me, the Roth IRA is so big when you're doing retirement planning because it gives you that tax control. Let's jump into that right now. All right, so now we're going to talk about the Roth IRA. So the third bucket consists of Roth, maybe municipal bonds, and here, money's coming in after tax, just like your paycheck. After you get your paycheck, those are the funds that you can put in this type of an account. It grows tax deferred. You're not getting a 1099 each year, right? And the best part is that it comes out tax-free. And the reason why this is good is that whenever you buy an investment, you put money into it, your hope is that that investment over time will grow and you'll get some sort of return. This return in a Roth IRA is also tax-free, right? So that is something important to keep in mind here. So when you have a balanced approach between all three different buckets, you can really control your tax situation. Let's hop into an example right now. Here's an example. Okay, so here we have somebody that lives off of $100,000 per year. Okay, and we're not going to be state specific. We're not going to look at state income taxes or any other part of this. But let's say he was taking or she was taking this amount solely out of a 401k. which is pre-tax, you're going to have to withdraw something closer to $118,000 per year, because you have to pay $18,000 in taxes. Now, that 18 is coming from the first, $80,000 being taxed at 12%, and then you have some tax at a higher rate. That blended rate minus the deduction gives you approximately $18,000. Now, let's say the same person was smart and saved up in a Roth IRA and a 401k. So the Roth IRA, and let's say we're just taking 50% out of both, right? So this example, we're just trying to show the benefits of a Roth IRA over a longer period of time. So the Roth is tax-free. You don't have to pay any taxes, so that equals there. And we need another $50,000 from the 401k for the lifestyle. Well, actually, you're going to have to withdraw closer to about, let's say, $55,000, which is about $5,000 in taxes. And you can see real quick is that you're getting the same lifestyle. This lifestyle is still based off $100,000 in income, but you're saving somewhere in the ballpark of $12,000 to $13,000 in taxes each year. And you take somebody who's 65 and is going to retire for 30 years or so, that can add up to a lot of money being saved. It can also add up to a lot of drawdown risk. And what I mean by that is when you have a portfolio and it has a drawdown and it exceeds, let's say, 4%, then that the drawdown is affected by the volatility. And when you have down years and you're taking large sums of money out, it's a lot harder to get back up. So those are the three basic buckets. I hope you enjoyed that. I hope you found it valuable. Hope you take some notes and learn something. If you have any questions or if you have any suggestions for future videos, please put it in the comments below, and I'll do my best to create a video on that. For now, thank you.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Client First Capital LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Client First Capital LLC and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Client First Capital LLC unless a client service agreement is in place.